Imagine waking up tomorrow. Your savings account shows the same number, but everything costs twice as much. This isn't science fiction. It's happened before, multiple times, to empires far stronger than ours. And right now, as you watch this, the greatest wealth transfer in human history is already underway. Peter Schiff isn't the only one warning us. Goldman Sachs says gold hits $4,900 by 2026. JP Morgan says $555, but Schiff goes further, $6,000 or more. The question isn't if the dollar's dominance ends. It's whether you'll be ready when it does. Because what's coming isn't just an economic shift. It's a complete restructuring of global power. And most people won't see it until it's too late. This isn't the first time a reserve currency has collapsed. Let me take you back. Rome, 211 AD. The Roman denarius contained 95% pure silver. It was the world's reserve currency. Trade across 3 continents depended on it. But Rome had a problem. Military expansion, infrastructure, endless wars. Sound familiar? By 265 AD, just 54 years later, the denarius contained only 5% silver, a 95% debasement. Inflation exploded. Food prices increased 20-fold. The middle class vanished overnight. Soldiers refused payment in denarii. They demanded land, gold, anything real. The empire didn't fall to barbarians first. It fell to monetary collapse. Fast forward to 1914, the British pound. For over 200 years, the pound sterling was the undisputed global reserve. At its peak, it represented 60% of world reserves. Then came World War I. Britain financed the war by printing money and accumulating debt. By 1918, the nation owed $4.7 billion to the United States alone. The pound's reserve share dropped to 40% by 1920. By 1944, it was under 10%, a 30-year collapse of what seemed invincible. Today, the pound represents less than 5% of global reserves, a shadow of empire. Weimar Germany, 1923. January 1919, $1 equals 4.2 German marks. November 1923, $1 equals 4.2 trillion marks. Read that again? Trillion. The government printed money to pay war debts. At first, slowly, then exponentially. Workers were paid twice a day because prices doubled between morning and afternoon shifts. People burned money for heat. It was cheaper than buying firewood. A loaf of bread cost 200 billion marks. Life savings disappeared in weeks. Pensions became worthless. The middle class was destroyed. This wasn't gradual decline, this was freefall. August 15th, 1971, the Nixon shock. President Nixon appeared on television. 9 minutes. That changed everything. I have directed Secretary Connolly to suspend temporarily the convertibility of the dollar into gold. Temporarily. That was 54 years ago. In 1971, gold was $35 per ounce. Today, over $4,500. That's a 99% loss of purchasing power. Since 1971, the dollar has been backed by nothing but trust and a military. For half a century, that was enough. But here's what's different now. Every previous reserve currency collapsed when there was a clear successor waiting. The pound gave way to the dollar. This time, there's no single successor. This time, it's a multipolar world, and that makes what's coming more unpredictable, more volatile, more dangerous for those unprepared. Let me show you the numbers. Real numbers. Current data. As of December 2025, U.S. national debt stands at $38.4 trillion. That's not the scary part. The scary part is how fast it's growing. We're adding $1 trillion in new debt every 100 days. That's $365 trillion per year. Interest payments alone exceeded $1.1 trillion in 2025. That's more than defense spending, more than Medicare. We're now borrowing money just to pay interest on money we've already borrowed. This is the debt spiral, and once it starts, it's nearly impossible to stop. But here's the revelation most people miss. The world is watching, and they're moving. The dollar's share of global reserves has dropped to 58% as of Q3 2025. 10 years ago, it was 67%. That might not sound dramatic, but in reserve currency terms, that's a landslide. Who's taking that 9%? Gold, yuan, euros, and something new, the BRICS unit. In late 2025, Brazil, Russia, India, China, and South Africa launched a pilot digital currency. 40% backed by gold. Initial processing volume, over $15 billion in cross-border transactions. This isn't theory anymore, it's operational. Saudi Arabia is conducting oil transactions in yuan. The UAE is settling trade in dirhams. Argentina, Egypt, Ethiopia, Iran, they've all joined BRICS or expressed interest. More than $400 billion in bilateral trade is now bypassing the dollar entirely. Central banks know what's coming. World Gold Council data shows central banks purchased over 1,000 tons of gold in 2024. They are on track to exceed that in 2025. Who's buying? China, Russia, India, Turkey, Poland, Singapore. Even nations traditionally aligned with the US are diversifying reserves. Poland increased gold reserves by 140% since 2018. Singapore won't even disclose its holdings. And then there's gold itself. December 2025, gold trades above $4,500 per ounce. That's up from $2,000 just 2 years ago, a 125% increase. But here's what most analysts won't tell you. Gold isn't rising because people suddenly love shiny metal. Gold is rising because currencies are falling. Every fiat currency is in a race to the bottom. Competitive debasement. When everyone prints, no one wins, except those holding real assets. Peter Schiff has been warning about this for 2 decades. He was early, but early isn't the same as wrong. Goldman Sachs now projects gold at $4,900 by end 2026. JP Morgan's model suggests $5,055 average for 2026-2027. Schiff goes further, $6,000 by late 2026, potentially $10,000 by 2030. Is he crazy, or is he just looking at what history always shows? When debt exceeds 120% of GDP, currencies collapse. The US debt to GDP ratio is currently 126%. Japan is higher, but they owe money to themselves. The US owes money to the world, and the world is losing patience. This isn't conspiracy, this is data. The dollar's reign isn't ending next week, but the foundation is cracking. And once confidence breaks, the decline accelerates exponentially. Let me walk you through what happens next. Not what might happen. What the data suggests is already in motion. Phase 1, 2025-2027, the foundation cracks. We're already here. Gold breaks $5,000 per ounce by mid-2026, possibly $6,000 by year-end as Schiff predicts. Why? 3 catalysts converge. First, the Federal Reserve is trapped. Inflation stabilizes around 3 or 4%, but refuses to hit 2%. Raising rates further collapses the housing market and creates a recession. Cutting rates reignites inflation, so they do nothing, and doing nothing is choosing inflation. Second, the BRICS unit expands. By 2027, processing volume exceeds 100 billion. More nations join. More trade bypasses dollars. Third, a debt ceiling crisis. Political gridlock in Washington creates a brief technical default scare in 2026. Even a week of uncertainty sends gold soaring. Treasury yields spike. Dollar weakens. Gold responds. Phase 2, 2028-2030. The acceleration dollar. Reserve share drops below 50% for the first time since World War II. This is psychological. The majority threshold matters. Once the dollar is no longer the majority reserve, alternatives gain legitimacy. Gold hits $7,000 to $8,000 per ounce in this phase. But it's not just price, it's what gold represents, the failure of the fiat experiment. Countries accelerate repatriation of gold reserves. Germany, Italy, and France demand physical gold held in New York be returned home. When allies don't trust your vaults, they don't trust your currency. Real estate in the US sees divergence. Luxury properties in stable areas hold value. Middle-tier properties in declining cities lose 20 or 30%. Stock market becomes volatile. Tech stocks collapse as cheap capital disappears. Commodities, energy, and gold miners soar. The wealth gap becomes a wealth chasm. Phase 3, 2031-2033, the crisis. Something breaks. Maybe it's a major bank failure, maybe a pension fund collapse, maybe a state defaults, but something breaks. Inflation spikes to 8 to 12% in the US, despite official numbers claiming lower. Anyone who buys groceries knows the truth. Gold explodes past $10,000 per ounce. The government responds with capital controls, limits on international transfers, restrictions on gold purchases, talk of wealth taxes and windfall taxes on gold profits. This is when most people panic, and panic is the worst time to act. Ray Dalio calls this the late stage of the debt cycle. Currency collapses accelerate. Social unrest follows. History shows this pattern never fails. Phase 4, 2034-2040, the new equilibrium. Eventually, stability returns. But it's a different kind of stability. The dollar still exists, but it's one currency among many, not the reserve, not the king. A new system emerges, possibly backed by a basket of currencies and commodities, possibly blockchain-based. Gold settles into a range, perhaps $8,000 to $12,000 per ounce in 2040 dollars. Those who prepared early don't just survive, they thrive. Those who didn't, they're still recovering. This is how it unfolds, not overnight, but unmistakably. The question isn't whether this happens. The question is, which side of history will you be on? Enough predictions. Let's talk about what you do right now. You can't control central banks, you can't control governments, but you can control your response. Here are 7 actionable steps to protect yourself and your family. Step 1. Allocate 10-20% to physical gold. Not paper gold, not ETFs. Physical gold you can hold. Start small if needed, 1 ounce coins, half ounce, even quarter ounce. Buy from reputable dealers, American Eagles, Canadian Maple Leafs, Austrian Philharmonics. Store some at home in a safe. Store some in a private vault, not a bank safety deposit box. Why? Because in a crisis, banks close. Vaults remain accessible. Gold isn't about getting rich, it's about preserving what you already have. Step 2. Diversify currency exposure. Open a multi-currency account if possible. Hold euros, Swiss francs, Singapore dollars. If international banking isn't accessible, buy foreign currency through reputable exchanges. Hold 5 to 10% of liquid savings in non-dollar currencies. When the dollar weakens, these holdings gain relative value automatically. Step 3. Invest in hard assets. Real estate in stable areas, not speculative properties. Practical homes in communities with strong fundamentals, farmland. Productive land holds value regardless of currency. Commodities, energy stocks, companies that produce physical goods the world needs. These assets have intrinsic value. Paper assets don't. Step 4. Eliminate or minimize bad debt. High-interest credit cards. Personal loans, anything above 6 to 7% interest. If inflation spikes, fixed-rate debt becomes easier to pay. But variable-rate debt becomes crushing. Lock in fixed rates where possible. Pay down high-interest variable debt aggressively. But don't rush to pay off a low-interest fixed mortgage. Inflation helps borrowers with fixed debt. Step 5. Build recession-proof skills. Economic instability creates opportunity for those with valuable skills. Learn repair skills, plumbing, electrical, carpentry. These never go out of demand. Digital skills, coding, design, marketing, these translate across borders. Medical skills, people need healthcare regardless of economic conditions. The most valuable asset you have is your ability to create value for others. Step 6. Maintain a 6 to 12-month emergency fund. Keep cash accessible for immediate needs, not invested, not locked in CDs. This seems to contradict diversifying away from dollars. It doesn't. Short-term volatility requires liquid capital. You need dollars to operate in a dollar economy, but long-term, store wealth in assets, not currency. Step 7. Stay informed and flexible. This situation evolves monthly, not yearly. Follow credible sources, World Gold Council, IMF reports, central bank statements. Ignore sensationalism. Focus on data. Be willing to adjust. What works in 2026 might not work in 2028. Rigidity kills in volatile times. Flexibility thrives. Bonus action. Build community. The wealthiest person in a collapse isn't the one with the most gold. It's the one with the most trusted relationships. Build networks, help neighbors, create mutual support systems. History shows communities survive, individuals struggle. This isn't just about money, it's about resilience. Start today, not tomorrow. Today. Because the best time to prepare was 10 years ago. The second best time is now. The dollar's dominance is ending. Not because I say so, not because Peter Schiff says so, because history, data, and basic mathematics say so. Empires rise, empires fall. Reserve currencies are no different. Rome lasted centuries. The pound lasted decades. The dollar has lasted 80 years. Nothing lasts forever. But here's the empowering truth. You don't need to predict the exact date. You don't need to time the market perfectly. You just need to prepare before the crowd realizes what's happening. Gold at $6,000 by end 2026 isn't the end. It's the beginning. The beginning of a new monetary system, a new distribution of global power, and a new opportunity for those who see it coming. The wealth transfer is happening whether you participate or not. The only choice is which side you're on. So let me ask you, what percentage of your portfolio is currently in gold or hard assets? Drop your answer in the comments. Let's see where everyone stands. And if this video added value, hit that like button. Subscribe for more economic deep dives that cut through the noise. Share this with someone who needs to hear it. Family, friends, anyone who's worried about the future. Because preparation isn't about fear, it's about power. The power to protect what you've built. The power to thrive when others panic. The collapse is coming. But you don't have to collapse with it. See you in the next one.